On the program today, World Bank says an African trade deal could lift millions out of poverty. IMF approves a $4.3 billion loan to help South Africa to fight the COVID-19 pandemic. Plus, the AFDB president, Akinwumi Adesina, completely exonerated by a high-level independent review panel. Many thanks for joining us on the program. I am BC Adebayo. Let's begin the show with intraday numbers coming from the major markets we track in Africa, which were mostly positive, except South Africa's GSE, which was down 0.32%. Now, here in Nigeria, the main index was up marginally by 0.05%. Elsewhere in Egypt, the index rose 0.08%, while Kenya closed Monday's session positive. But there's also a similar sentiment in most major stock markets in the Middle East, with the Qatari index gaining 0.22%, while Saudi Arabia's benchmark index dropped 0.05%. Elsewhere, Abu Dhabi's index failed to sustain gains from Monday, dropping 0.15%, while Dubai's main share index rose 0.19%. And in Europe, stocks advanced this morning as signs of progress on fresh U.S. government stimulus efforts seemingly outweighed concerns about a coronavirus resurgence worldwide. But let's cross over to Frankfurt, where Chelsea Delany is standing by to tell us more about that. Good afternoon, Chelsea. The German health officials say that they are very worried about rising coronavirus cases. Of course, Germany was widely praised for its efforts to contain the virus. But how serious is the new wave of outbreaks?
Well, public health officials here are saying it's not yet a second wave of infections, but they clearly are signaling a high level of concern about the increases that we've been seeing. For the past several weeks, the level of infections, the growth of new infections every day was around 300, 400 a day. Over the past week, we've seen that shoot up to around 800, 700 a day. So there clearly are more infections here. A lot of them still remain quite localized. So we have seen some outbreaks in specific places. It doesn't appear that they are spreading outside of those areas yet, but we are hearing more and more from health officials and from politicians here that people obviously need to remain vigilant. And we also have Germany joining France and the UK and warning against travel to these regions in Spain that are seeing heavy outbreaks right now. So at this point, it's not for Germany a huge outbreak like we've seen in Spain, but especially given the fact that things have reopened for the most part, and that travel has now picked up between Germany and other countries, there certainly is more concern that that this could start to really accelerate soon, and that, of course, would be catastrophic from a public health standpoint, but also from an economic standpoint if there do have to be more restrictions put in place, because we've already seen how damaging that is, and it would also deal a big blow to confidence.
Now, let's talk about something else. We said mixed results out today from the auto sector. Of course, France's Peugeot managed to post a profit in the first half of 2020, while Japan's Nissan is forecasting a loss of $6.4 billion this year. Walk us through those results.
So yes, these are two of the biggest automakers, and they do seem to be telling slightly different stories. I'll start with Peugeot, which did actually really surprise the market with these results. Most investors and analysts had been expecting the company to report a loss for the first half of the year. They did manage to eke out a profit. They say that they are continuing to see sales accelerate. So that obviously is a good surprise for investors. The stock also did shoot up pretty high today in trading. And then we have, on the other hand, Nissan, which is really not giving investors anything to be hopeful about. This would be a very significant loss for Nissan. And they already had a lot of underlying problems coming into this year with their a lot of executive turnover after the arrest of their CEO, Carlos Ghosn. So they had a lot of structural and fundamental problems, but it does appear for the most part that a lot of automakers are starting to see an acceleration. Whether that will last, whether this will be disrupted by the pace of outbreaks around the world, it's a little unclear yet. But for now, most automakers are starting to see sales pick up, especially helped here in Europe by these incentives from governments to get people buying cars. So certainly it's still going to be a really tough year for every automaker, but they do seem to be seeing some pickup in sales.
In other news, Chelsea, European Central Bank has asked banks to hold off on paying dividends or executive bonuses until next year amid the pandemic. How are investors reacting to that news?
It's definitely a blow for investors. Bank shares here in Europe have already fallen quite significantly this year. The Euro Stoxx banking index is down about 35%. That's compared to a loss of about 10% for the broader Euro Stoxx index. So banking shares are getting hit disproportionately hard in this pandemic. That's a lot because we are still expecting quite significant problems for banks as we see more bankruptcies, as we see more people defaulting on loans. There is expected to be a large blow to these financial institutions, and that's really why the ECB is saying, okay, you need to save as much money as you can right now. So this includes a lot of things like anything that would really deliver the shareholder return, so dividends, buybacks, but also executive compensation. They're telling the banks to be quite restrained on executive compensation this year until they get a clear sense of how deep the damage is going to be to their balance sheets.
All right, Chelsea, thank you. See you tomorrow. Let's take a trip to London, where the latest reports show that shoppers spend more on food and drinks this month. Juliana Olayika is standing by to talk about this and more this afternoon. Good afternoon, Juliana. So latest reports from the Confederation of British Industry shows that UK retail sales rose in July to its highest level in over a year, mainly because of higher grocery sales. Can you walk us through those numbers and how the markets are reacting to them?
Good afternoon, Bissy. Well, the markets haven't reacted to this data, I've got to say. The Confederation of British Industry, it's kind of really showing that there has been the modest growth, which was reported last week from the Office for Budget Responsibility, showing that, yes, of course, as soon as the lockdown measures were restricted, people were going out, people were spending. But I think there's a caveat to all of this information, and that's out of the sectors that the CBI look at. The only sectors that have shown growth is groceries, DIY and hardware. So that's pretty obvious, isn't it? People haven't really been spending in the department stores or in clothing stores, which is what the British government are desperate to get people to do. Also, as well, one of the reasons why I believe markets haven't picked up on this data is that when it comes to retail spending, that only accounts for about a fifth of household spend. And we do know, again, from the information we received last week from the OBN, is that a lot of households are reallocating some of their funds. So because not all of the hospitality industry is open to its fullest yet, some people that would be spending money wining and dining are spending money on groceries and on hardware and games. So that's that information. The FTSE's underwater at intraday. It did start off on a high, but Donald Trump's new $1 trillion stimulus package has really worried traders. That billions, those billions and billions and billions of funds, a trillion, is going to go into government departments, including schools and businesses. But it has re-emphasised the fact that the world's largest economy is really struggling to get a grip on COVID-19. Boris Johnson, the British Prime Minister, he is actually on holiday, on a British holiday at the moment, but he was giving a press briefing to the media, and he did say that, the second wave of COVID is on its way, and that has spooked investors. So at intraday, the all-share is down 0.05%. The FTSE 100 is down 0.21%, and the FTSE 250 is up by 0.43%. 0.8%. In the currencies market, the pound is down on the dollar by 0.08%, up on the euro by 0.15%, and down on the Japanese yen at intraday by 0.18%.
Meanwhile, Juliana, bakery chain Greggs says that sales will not recover to pre-pandemic levels for as long as social distancing rules are enforced, but also says that it was encouraged by its performance since reopening. Tell us what's behind the encouragement despite closing over 2,000 stores.
Well, Greggs is a staple name here in Britain. Their sausage rolls have called one or two arguments on social media. But of course, as with every other store like Greggs, they did have to close their doors. I believe they have about 2,050 stores. And apparently they have opened a handful of them. But the reason why Greggs are in the news today is because they've reported their half-year sales, and their sales are down by 65.2 million pounds. The same period last year, they were in profits of 36 million. So it's badly hit them. One of the reasons why they're still a little bit optimistic is because their chief exec decided to not pay out dividends of 2019. They should have been paid out within the next couple of days, and they've saved 33 million pounds. And they said, look, you know, they'd rather have that cash at their disposal just in case there is a second wave and they have to close down their stores again. They also said that they won't be paying out their 2020 dividends, which will be due next year. Shareholders, I'm sure, will not be happy with that. But another part of their optimism is that they say, unlike a lot of the other high street coffee chains like Pret, they do not solely rely on the kind of office worker that can only work on home. A lot of Greggs' support base are builders, contract workers, and many of them have continued working throughout, and so they're happy to have them. At the moment, they said they're working at a 72% capacity. They said as soon as they can start working at 80% capacity, then they'll be breaking even, which is what they want.
All right, let's talk about the Institute for Employment Studies now, which has released a report saying that the number of people claiming unemployment benefits per job vacancy in Britain has increased fivefold since the onset of the coronavirus pandemic. Of course, Juliana, this doesn't come as a surprise anymore. But how are recruiters actually coping with this huge demand?
Well, they'll be busy. They'll definitely be busy because there are a lot of people looking for jobs at the moment. I believe unemployment still stands by about 3.9%. Again, we've discussed this extensively, that's being supported by the government's furlough scheme. They're subsidising people's wages. It is tapering off, and some employers are not waiting for it to taper off. Of course, we just heard about Selfridges earlier this morning. They're letting go about 450 staff, and their staff are still furloughed. So it is a major concern. Before the pandemic, with every job vacancy available in the UK, there was about 1.5 individuals applying for job benefits. As you said, it's increased fivefold. I believe with every job vacancy, there are about 8 individuals looking or seeking job seekers allowance, as it was once called. There are some examples that were given within this report. I believe there was one head of house bar manager's job going at a pub just outside London. Now, typically for that, you wouldn't get loads of applicants, but in one day, the owner got over 1,500 applicants, which just goes to show how desperate people are to get some work. Recruitment companies say it's very competitive at the moment. I think LinkedIn have also chimed into this report saying that, you know, there's an increased activity, particularly in the UK, for people to try and get jobs. So it is particularly worrying. I believe when the Chancellor of the Exchequer, Rishi Sunak, delivered his spring statement a couple of weeks ago, he did say that they are going to be putting a lot more money in the Department of Work and Pensions, which is the government department that look after jobs and the universal credit claims, to try and help people retrain, to try and let people upskill. But the concern is for a lot of young people. Already their studies have been disrupted over the past couple of months. These are the people that will be coming out in the summer, anytime now, looking for a role. It's usually in retail. We know retail already has lost so many jobs, 250,000 expected to go by the end of the year. So again, yes, pretty much stating the obvious, but still very worrying, and a reminder to Boris Johnson's government that the labour market and unemployment is of major concern if they are going to try and get the economy a kick that it needs.
I can imagine, Juliana. Thank you. We'll see you again tomorrow. Our commodities market update is up next when we return in just a moment. Please stay with us. Welcome back. Now, recently, the National Emergency Management Agency issued a warning that about 102 local government areas in 28 states were highly probable flood risk areas. Now, the agency also stated that it had started stockpiling food and non-food items as part of measures to cushion the devastating effects of the impending floods across the country. But how would this impact food prices and inflation in the coming days? A research analyst at the financial derivatives company Maywa Ige will be answering this question and more on our commodities market update today. Good afternoon, Maywa. Thanks for joining us on the program. So the NEMA report is forecasting a rainfall level of 2,700 millimeters of rain, which is 11% higher than what we saw in 2019. And that's in addition to the supply chain disruption due to COVID-19. So what do you think will be the impact of this on food inflation and prices of domestic commodities?
Hello, BC. Thank you for having me. The NEMA report is an annual report that NEMA releases to guide sectors of the economy and on how to plan for the likely consequences of rainfall. But then this heavy rainfall that's been predicted, it can actually be beneficial to agricultural production as it will boost output. We've already been hearing reports of how the rainfalls have been helping the rice plantations in Hadeja and Jigawa states. And also the Ministry of Agriculture in Akure mentioned that the rainfall is actually helping the growth of their new cocoa seedlings, and they're expecting an increase in the output of cocoa seedlings at the end of this year, next year. But then you know that with heavy rainfall comes the risk of flooding, which is where the issue is. And flooding greatly affects agricultural outputs. It leads to loss in crop, and then limits the distribution of agricultural produce from the rural areas to the urban areas. All of this leads to a shortage in the supply of commodities, of food commodities in the urban areas and the rural areas. And the resulting effect of this is that you see an increase in the prices of food, and an increase in price leads to an increase in food inflation. However, it's important to note that food inflation is not only dependent on the weather conditions and the prices of agricultural production, especially in a country like Nigeria, because we are heavily dependent on importation. And so you can see some government policies like border closure and also the exchange rate adjustment that just happened can also influence food inflation.
Now, Maywa, another issue on the front burner is the fact that there is a sharp divergence between urban and rural inflation in Nigeria, principally because of logistics and distribution costs. And the meteorological report means that these costs will increase as bridges and roads are flooded. Now, do you think that the local markets in rural areas can absorb the stranded supply?
No, they cannot. Because if you, the rural areas have contributed just about 26% to the labor force in the country, which says a lot about their purchasing power. They do not have the adequate purchasing power. And then the urban area the population of the urban area is about 53% of the country's population. And also, if we look at a state like Lagos State that has an estimated 20 million inhabitants, we see over 13,000 trucks of food coming into the state daily, delivering food. If this is cut off, the rural areas don't have the population to absorb this excess supply, and also they don't have the purchasing power to absorb it. So we would see in the rural areas, we will see a decrease in the prices of commodities in the rural areas, which will lead to a decrease in the rural food inflation. And on the other hand, in the urban areas, we will see a shortage of food supply, and then which would also mean a hike in prices of commodities in the urban areas, and also a hike in urban food inflation.
But do you think that Nigerian policymakers, farmers and investors have learned any lessons at all from previous year flood disasters? And if so, why are we still in panic?
I'd say to an extent they have, but not totally. Now everyone is aware that there's something such as the seasonal rainfall prediction that NEMA releases every year. And then also NEMA released it earlier in the year to help sectors of the economy plan ahead. But the reason why I'll say we haven't totally is because yes, we're aware, people are talking about it now, which is not what we had in previous years. But then the problem is we are still reacting, we're not being proactive, which is where the issue lies. If we're still waiting for the rainfalls to begin before we start putting measures in place to actually mitigate the flooding. If we were being proactive, we would have seen situations such as states building drainages, correcting issues with drainages even before the rains begin. And then we'll also see things like road maintenance, because you know that if you have a small pothole on the road, excess rain, flooding widens the road and then causes major problems in transportation. We're not seeing that yet. Till we start moving from the reactive state to the proactive state, then we would now stop. That's when I think we will stop suffering from the effects of flooding.
Many thanks, research analyst at the FDC, Maywa Ige, for your input on the program. And the World Bank says a pandemic-delayed African free trade deal, if fully implemented, could boost incomes across the continent, pull millions out of poverty, and cushion against the negative fallout from COVID-19. World Bank researchers estimate that the trade deal will lift 30 million Africans out of extreme poverty and 68 million from moderate poverty by 2035. Full implementation could increase real income in Africa by 7% or nearly $450 billion, mainly by reducing the cost of trade through the elimination of tariffs and red tape. According to the World Bank, the volume of total exports would increase by almost 29%, with exports between African nations rising 81%. Meantime, the International Monetary Fund has approved $4.3 billion in emergency financing for South Africa to help the country address the severe economic impacts and health challenges of the coronavirus pandemic. The IMF says the rapid financing instrument loan, equal to 100% of South Africa's IMF quota, will help fill urgent balance of payments needs from pandemic-caused fiscal pressures. The loan will also limit regional spillovers and catalyze additional financing from other international financial institutions. Africa's most industrialized economy, which relies on foreign investors to fund its twin current account and budget deficits, was in recession even before COVID-19 started ravaging its economy. The president of the African Development Bank, Akinwumi Adesina, has been cleared innocent of all allegations of favoritism by an independent investigative panel set up to review the U.S.-led rejection of the Ethics Committee report, which exonerated the bank chief of all charges. The panel, led by former Irish President Mary Robinson, says it's satisfied with the findings of the committee, paving the way for Mr. Adesina's re-election to run the multilateral lender for another 5 years. Mr. Adesina was accused of favoritism, handing contracts to acquaintances and appointing relatives to strategic positions in the bank, allegations he has since denied. And that's where we end today's program. Thank you for watching. I am BC Adibayo.